Hi, and welcome to this Market Outlook podcast for the second half of 2020. My name is Thomas Christensen, and I'm the head of sovereign and frontier debt at UBP Asset Management. Our team remains constructive on hard currency emerging and frontier markets debt going forward for a number of reasons, but on this podcast, I'll highlight three that we believe are important and relevant today. The first is the significant policy measures we've seen globally. Here I'm referring to the massive global stimulus we've seen so far and continue to see, both fiscal and monetary. And for emerging markets, specifically liquidity relief. Second, we believe the impact on emerging and frontier economies from coronavirus is likely to be smaller than that we've seen in developed markets and smaller than people might fear. And third, from a markets perspective, we believe emerging markets debt currently offers attractive levels, particularly when compared to developed market counterparts. Now let me go through each of those points in a little bit more detail. Regarding stimulus, we've seen fiscal stimulus in developed markets helping lessen the economic pain. To the extent that emerging markets rely on growth in and demand from developed markets, this is clearly helpful to our world as well. Accompanying this, we've also seen historic levels of monetary stimulus. We have near zero interest rates across most of the developed world, yield curve control in Japan, and so on. The result is just under $13 trillion worth of negatively yielding assets. And on top of that, we recently have the Fed buying corporate bonds and wanting to bring the credit market back to levels at or near those prevailing prior to the COVID-19 dislocation. This is an aggressive target. Just before the pandemic, credit markets reached multi-year lows in terms of spread levels and volatility, bid-ask spreads, and curve shape. Essentially, the Fed continues to follow the whatever-it-takes strategy, which has the potential to create bond scarcity. And with this policy in place, we believe investors are going to need to start looking further afoot for yield, which is clearly supportive for emerging markets. In more EM-specific policies, we have the combination of the G20 debt relief initiative and significant IMF support. In the middle of April this year, the G20 officially offered to suspend principal and interest payments for the world's poorest countries, specifically defined as the IDA, or International Development Association countries. This includes a significant portion of the frontier countries. On top of that, the IMF pledged $1 trillion worth of available funds, including $100 billion in rapid financing instruments. The combination of these factors helps significantly with any liquidity concerns. And to the extent more countries might seek out official IMF programs beyond the rapid financing, it would also be constructive for policymaking and structural reform potential. It's important to note that we don't believe these measures will save every country. We have already seen 3 sovereign defaults this year, but in many cases it's sufficient. So we believe it continues to be important to be selective and will remain so going forward. The second point is regarding the impact on emerging markets from the COVID-19 crisis. There's been much concern about poor countries' economies in the face of COVID-19. This centers around a few main points. Poor countries having less well-established healthcare systems with less room to enact stimulus packages and facing financing gaps. While each of these points is true to varying extents, we believe there are substantial mitigating factors. This is not to say that some emerging countries will not be badly affected. We're currently seeing a few EM economies and countries struggle with the virus, and those tend to be where there can be found higher population density and comparatively older populations. And that's because we know coronavirus disproportionately affects the elderly and those with pre-existing conditions. Globally, only around 4.5% of the deaths we've seen have been in people under the age of 65 without pre-existing conditions. In the US, the median age of people dying from COVID-19 is around 80 years old. Emerging markets tend to have younger population, and this is particularly true for the frontier countries. Sub-Saharan Africa, for example, has a median age below 20 years old, and less than 3% of the population is above 65. In Europe, more than 20% of the population is above 65 years old, and in the US, it's roughly 16%. So it's no surprise that the impact we've seen so far in terms of lives lost is less severe. The official statistics suggest much smaller case numbers in Africa so far, and much of that has been attributed to lower testing. That's almost certainly part of it, and it's very possible we've seen many more people affected than we know, and then the official statistics suggest. But with age playing such an important role, the young populations of these nations is likely to result in far fewer deaths. And in countries that already face higher risks in their daily lives anyway, the willingness to shut down is much smaller. In part because African economies are less productive, less interlinked, and much less leveraged than advanced economies, they're also less likely to suffer structural, long-lasting damage from the pandemic. Most African countries have large agricultural and informal sectors. These have experienced fewer restrictions and dislocations than the formal economies. Also, a significant portion of sub-Saharan Africa, nearly 60% of the geography, is rural. These people are less likely to be exposed to the virus and have faced much less severe shutdowns. Some major East African markets, such as Kenya and Ethiopia, for example, are nearly 80% rural. The availability of credit to the private sector is also much lower in African markets, making them less susceptible to contagion. According to the IMF, private sector credit amounts to just over 10% of GDP in Nigeria and Ghana, for example. That compares to 187% of GDP in the US. South Africa is much more leveraged than the average African market, but even in South Africa, a number of factors leave them less impacted. A large informal sector of more than 20% of GDP, high poverty levels, with more than 55% of the population earning less than $5 per day, and high levels of pre-pandemic unemployment, 30% by some definitions, are all considerably worse than in advanced economies. And that might sound like a negative, but those realities can mean that the scale of the new pandemic-induced economic dislocation is relatively small compared to the pre-existing conditions. For example, economists estimate that unemployment has increased by around 10 to 20% in South Africa from the starting level, compared to nearly 300% increase that we've seen in the US. Ultimately, the latest IMF projections, which are now a couple months old, suggested a growing growth differential between emerging and developed countries. The gap between developed and emerging markets has been around 2% in recent years, and IMF projections from April had that swelling to 5% in 2020, due to recessions in developed markets that are much more severe than those in emerging countries. And we still see projections of small positive growth numbers in a number of emerging and frontier countries. And regarding the point on financing gaps, the relief from the G20 and the support from the IMF and other multilaterals that I've already mentioned has already gone a long way in solving these. And the final point is more markets related and particularly refers to the hard currency segment of EM debt, where we believe current levels still offer a compelling entry point. Spreads between emerging and developed markets have widened out significantly, as the recent rally has been much more pronounced in developed markets. Corporate EM investment grade historically is around 90 basis points wide to US investment grade, and at the end of May, that spread was 134 basis points, meaning roughly 45 basis points wide to the historical average. In broad sovereign space, emerging market sovereign debt currently yields roughly 530 basis points more than developed markets. Historically, that average has been around 400 basis points. Now, this is being driven in large part by the sovereign high yield portion, which arguably is tough to compare to developed market government bonds. A more interesting comparison is perhaps to US high yield. The spread between the yield of frontier markets and US high yield over the last 3 to 5 years has been somewhere between 50 and 75 basis points on average. Today, that spread is above 175 basis points. Over the history of frontier debt as an asset class, frontier markets have significantly outperformed US high yield. We have data back to the end of 2001, so nearly 20 years of data. And over that period, frontier markets have outperformed US high yield by almost 135% to the end of May of this year. That's 175 basis points per year. This is despite yield to maturities that are relatively similar through that cycle. And the main reason for the difference is the realized losses from defaults. In the history of this asset class, we've seen roughly 2% of the frontier index default per year. This compares to almost 4.5% of US high yield. And recovery rates in frontier markets have been substantially more also, at roughly 60%, where they've been around 40% in US high yield. So we like holding frontier debt through the cycle for the combination of attractive carry and relatively low defaults and realized losses. And with spreads to US high yield today at very wide levels compared with history, we think that argument is even more compelling. So to conclude, we believe hard currency EM debt broadly offers a compelling investment opportunity. First, due to the vast stimulus across the globe, both fiscal and monetary, which will be constructive for EM debt, combined with the liquidity relief I mentioned. Secondly, we believe the fears of the coronavirus impact on emerging markets specifically is perhaps overstated. And finally, the combination of these factors has led to a good entry point into EM debt, as our asset class offers more significant yield and spread pickup to comparable developed market assets than what we historically used to seeing. Thanks for listening, and for more information, please contact us or visit ubp.com.